Welcome everyone. Thanks for joining us today. Um, Today's webinar, we will be talking about turning your pensions into paychecks, and our host for today is Greg Armstrong. After the webinar, there will be a poll and a survey, so feel free if you have any questions, and we'll get to it after Greg's presentation is complete. Without any further ado, I'm going to hand it over to Greg. All yours.
Good morning, everyone. I hope you guys are doing good. It's a great time for my 2-year-old to be bashing at my door, but we shall endeavour to proceed. Yes, topic for today, turning pensions into paychecks, even in turbulent markets. So attendees-wise, we are ticking upwards, so we'll give that a few more minutes. Just looking at people coming in here. So we'll give that 1 or 2 more minutes. We're looking at about 20 minutes, 25 minutes, depending on questions and engagement. I will be asking a few questions, so if you'd like to share your thoughts, please do so in the chat function. So let's go through the necessary bits here. So risk disclaimer, we do this for every webinar. This presentation is for information purposes only and does not constitute any financial, legal, or accounting advice. Ascot Wealth Management is authorized and regulated by the Financial Services Authority. These investments are not suitable for everyone. Annual management charges do apply. Tax legislation could change in the future. The value of tax reliefs will depend on an investor's personal circumstances. And finally, these investments could fall or rise more than mainstream investments. However, you could get back considerably less than you invested. So those are the risk disclaimers done. We'll go ahead and, yeah, that's just a little bit about me. Been with Ascot Wealth Management for 10 years. Started as a pensions analyst, working on a lot of final salary schemes with the pension freeze in 2015. So lots of pension work to do. And then I've been advising clients since 2019 with a special focus on cash flow modeling, on building flexible, tax-efficient retirement strategies. A previous webinar that I did was involved a £50,000 tax optimized retirement income, blending pensions, bond income, ISAs, and essentially trying to pay zero tax, which was a previous webinar that I did. So this, looking at this theme here, largely along those same lines, just setting out the webinar agenda. So just talking about welcome and introduction. We look at the retirement landscape that has changed. We understand the biggest retirement risk, as well as the strategies for sustainable retirement income. We look at drawdown versus annuities. That's the age-old question in volatile markets. And then finally, key takeaways and next steps with some Q&A at the end. All right. Okay, I'm just looking at the attendees. Okay, great. Great. As I said, participation is encouraged. So, as I said, that make use of that chat function. I will try and read them as they come through. But what concerns? It helps if I go to the correct slide. Here we go. What concerns you most about retirement income right now? That's the question. While you look at this lovely couple here in what looks like rural America. Don't know about you guys, but that looks very rural America to me. But is it running out of money? Is it market falls? Is it inflation? Is it tax? Is it not knowing how much is safe to withdraw? What are your major concerns about retirement income right now? If you guys do want to hold a few questions to later or a few responses to later, you can build them up and we can always go back to it. But that's in this day and age, we've had a volatile recent period. The conflict in Iran, the straits, are they open, are they closed? Depends on the time of day, some might think. So there must be some people that are very concerned about their retirement income right now. And the adage goes, most people spend decades building wealth, but very few are taught about how to spend it sustainably in retirement. You work all your life, 40 years, in some cases at a company, and you get to your 65th birthday and your income stops. And now you are needing to supply your own sustainable retirement income from 65. What do you do now? Type of thing. Lots of, we'll get into that in a greater detail, but a lot of pressure falls on your shoulder at that point. Not trying to make this very downbeat, but yeah, there are some concerns out there right now about retirement income, which we'll touch on. Good. So, why has retirement changed? Why has it changed? So, here's a question. If markets fall 20% next year, would you feel comfortable to continuing to draw the same income? Obviously, you wouldn't feel comfortable, but that's questions that we will be asking ourselves in periods of market downturn, market volatility. So, longer retirements. I mean, retirements nowadays can last between 25 to 35 years, which is a departure from the past, with obviously advancements made in healthcare, et cetera. Inflation is also a big variable here. Rising costs reduce spending power over time. That's rising living costs, healthcare costs, energy and food inflation, and maintaining your lifestyle over time. I mean, everybody has that, outside of petrol, everybody has that one thing that they've noticed in the grocery store that is just marketably more expensive in the most recent while. For me, it's coffee. That's been an industry that's been quite hit, quite harshly hit with market movements globally. So, as I said, everybody's thinking of something that they've noticed that's jumped up in price over the last recent period. The next is market volatility. So larger market swings can impact retirement income. I mean, during your working years, volatility can be written out. I mean, a 35-year-old working right now with this volatility, they could work for another 30 years. So that's an example of riding out that volatility. But in retirement, withdrawals during downturns can magnify those losses, those short-term losses, which we'll touch on a little bit more. Lastly, responsibility shift. I've alluded to that already, but individuals now carry more financial responsibility. Gone are the days where we all had final salary pensions and you worked in that same company for 30, 40 years. And the shift from those final salary or defined benefit pensions to defined contribution pensions has been quite swift over the last 20 years. So that shows there's a greater need for personal decision making. And I mean, those words in and of itself is a bit daunting because I mean, it's going to be a personal decision that you make without relying on your employer paying you an income for the rest of your life, for instance. So now individuals are managing investment risk, withdrawal strategy, longevity risk, and tax planning. That's all on your shoulders now, where previously with a final salary pension, you were receiving your income monthly, you were receiving your P60, and there was no flexibility to change that. So again, building wealth is only half the challenge. Turning it into a sustainable income, that is the other half of the challenge. So what is the biggest risk that nobody talks about in retirement? and that's sequencing risk. Sounds a bit technical, but that question over here, and I will ask for some participation here. We've got about just over 20 attendees here, but what do you think is more dangerous in retirement? A market crash before retirement, or B, a market crash just after retirement? What do you think is more dangerous in retirement? Just what are your thoughts? Okay, I see someone is typing, so thank you. We'll allow a couple more seconds. Instinctively, a market crash before retirement or a market crash just after retirement? What do you think is more dangerous to retirement? No wrong answers here, but usually it will be B, a market crash just after retirement. Because poor market returns early in retirement can permanently damage sustainability. And that is done because taking withdrawals during downturns locks in those losses. And that's a concept that, I mean, when you are investing, the moment you sell an investment, that's when you actually lose or gain money. I mean, right now, if your investment is 5% up or 5% down, that's just you reading that just on a screen. You're reading that on a piece of paper. That's doesn't necessarily mean anything until you get to the point where you actually take that money, and that is when you lock in those gains or you lock in those losses. So taking withdrawals, just to repeat myself, during downturns locks in losses. So going into the next slide and touching more on this sequence risk. So we've got two scenarios, left and right. You can see on the left-hand side, pot exhausted after 20 years, and on the right-hand side, similar to starting pot size. I'm going to give you more context now, but you'll see at the bottom here, you've got from the year 2000 to the year 2023, and on the right-hand side, it's reversed, 2023 to the year 2000. So imagine two retirees, each starting with £1 million in a global equity portfolio, withdrawing £50,000 per year. So that's 5% of the starting value. 5%, is that sustainable? We'll discuss that, but that's £50,000 is adjusted for inflation. So on the left-hand side, investor number one, who retired in the year 2000, just before the dot-com crash and the 2008 global financial crisis. Although markets rebounded later, the early losses proved devastating. Their portfolio ran out after just 20 years, which you can see here. Then on the right-hand side, investor two is a time traveler who experienced the exact same investment returns, but in reverse order. What's the result? Their investment pot remained largely intact by the end of the period because they had strong market growth and enjoyed a near uninterrupted 15-year bull run. So that's why after that time period, you get one investor who is at zero and the other investor is close to his or her starting amount. I mean, obviously we are time travelers and we don't have that crystal ball, but this just gives you a sense that sequence risk is a major risk when it comes to retirement. Moving ahead, so what are the strategies to create sustainable income? I mean, I'm going to rattle through them just after asking this question. What would you rather? A, having a fixed guaranteed income, or B, flexibility with growth potential? You might find that depending on the day, depending on the news, you might toggle between the two responses. On a particularly bad news day, having a fixed guaranteed income could be a satisfying or relieving for you. But at times where markets are doing well, you want to see that 22% return in the S&P 500 in a year with that flexibility. But these are important questions to ask yourself to kind of see which strategy you should apply. So certain strategies. Number one, cash reserves. So the first layer of a sustainable retirement strategy is cash. This acts as a buffer in volatile markets. Holding cash helps avoid selling investments during downturns, because now you're not crystallizing or realizing that 5% pullback we had in March, for instance. It provides short-term stability for income needs because you've got a cash pot there waiting. So it typically comes 1 to 3 years of essential spending, depending on your risk profile. So the simple message here, cash buys you time, and time is what prevents you locking in losses. The next thing to discuss here is flexible withdrawals. Retirement income doesn't need to be fixed every year, and arguably it shouldn't be. Income can be adjusted based on market performance. It can allow you to spending to rise in good years and tighten in weak years. Helps reduce pressure on the portfolios during downturns. So flexibility is one of the most powerful tools when it comes to retirement planning. Diversification is another aspect to employ here, and that's not just relying on one single outcome. You're not just putting it into gold, for instance. You're spreading investments across different asset classes, which reduces risk. Different assets behave differently in different environments and helps smooth overall portfolio volatility. So the simple message there is you don't need the best performer. I mean, we all would have wanted NVIDIA back in 2010, but you just need the balanced mix that works well over time. The next thing to discuss is natural yield versus total return. And that's a common misconception, is that retirees should only spend income generated naturally by investments. So to explain that, so natural yield is dividends plus interest only. So you're not touching the capital. Where total return is income plus capital growth combined. So relying only on yield can unnecessarily restrict your portfolios. It might necessitate you picking a stock that pays a good dividend, but the growth, for instance, has not been matched by other growth stocks, for instance. So a total return approach allows more flexible and efficient withdrawals. So simple message there, it's not just about what investments pay you, it's about the overall return they generate. Tax efficient withdrawal sequencing, that's another concept here, and that's how you take money is just as important as how you invest it. Drawing from different tax wrappers in the right order improves outcomes. It can reduce lifetime tax liability. It can help preserve tax allowances and manage income tax bands, and typically involves coordinating ISAs, pensions, general investment accounts, offshore bonds, onshore bonds in a strategic manner. So simple message there is good sequencing can add meaningful value without taking any extra investment risk. So what does that look like when we compare drawdown versus annuities in volatile markets? Now, on the left-hand side, we've got drawdown, on the right-hand side, annuity. So which approach feels more appealing to you personally? Security or flexibility? I've missed a whole bunch of responses here, so I do apologize. Okay, so mostly B in that previous. Okay, sorry about that. I was on the wrong chat there, but getting back here. So drawdown versus annuities in volatile markets. So drawdown, flexible. You do still have market exposure, but you have that growth potential. And as you can see in that previous sequencing risk, 15 years of an uninterrupted bull market, I mean, that's a good place to be in. On the flip side of the coin, annuity, it's guaranteed. Stability, predictability. So what approach kind of feels more beneficial, more assured for you, on the left or on the right, drawdown versus annuity? And we go into a bit of detail here, looking at a £50,000 pension pot at age 65. Looking at three options here. You've got single life annuity, level, no guarantee. That in today's market right now is getting you between £3,500 to £3,900 per annum, guaranteed for life. That's an annuity rate of between 7 to 7.8%. Now, the main thing here is that that is level. So that's not going to increase in line with inflation. But you can look at the FTSE 100 over a 20-year historical total return. That's between 7 to 8% annualized return. And then you've got the S&P 500, 10 to 11% annualized return. So which bucket do you want to be in, type of thing? Going ahead to the next one, we're going to discuss that in a greater detail. And again, we've got further approaches here in terms of how you can protect yourself. So these are strategies that we can obviously discuss. So the first is the bucket approach. This is where you hold your 2 to 3 years of cash, you hold 2 to 3 years worth in cash or low risk assets, money markets. And that will, again, to reiterate, will cover spending during market downturns. It also helps you avoid selling investments at depressed prices. So that would be the bucket approach, a systematic funding of your cash buffer pot, so you don't need to kind of sweat the news cycle on a day-to-day basis, because you know that you've got 2 to 3 years worth of cash, or 2 to 3 years worth of income sitting in cash, for instance. The second here is flexible spending, or the guardrails approach. So this is, and we touched on this a little bit earlier, but this is, to reiterate, this adjusts spending based on market performance. So now you're kind of treating the market performance as literally performance, key performance indicators for yourself. You are giving yourself a pay rise when you've got, after strong markets. So that means that you're taking a little bit extra because performance has been good, and you're giving yourself sort of banking the profits. You could, in weak markets, take a pay cut within these guardrails, and this management on a periodic basis improves portfolio longevity and resilience. The third thing here is, or the third strategy here in terms of how to protect yourself, is conservative cash flow planning. So this is where you use cautious assumptions for returns and inflation. For example, 3.5% inflation, 6.25% nominal equity return assumption. I mean, we saw the FTSE 100, we saw S&P 500 performing better than that over the last 20 years. So now we just be a bit more conservative. And that creates just a margin of safety in planning outcomes. So this often leads to outcomes actually exceeding expectations. I mean, if we are being super cautious, and after a time period where performance has outpaced that cautious amount, or that cautious growth rate, then again you feel a lot more assured. The fourth is the partial annuity strategy. So this is where you use part of your portfolio to secure guaranteed income. We call it sort of a hybrid income approach. That removes market risk for essential spending, so you know that your lights are going to be kept on outside of market performance, and that reduces reliance on investment performance. That helps, so in turn, that helps stabilize income during volatility. The fifth and final option here in terms of how you protect yourself is the flexibility to work again, sort of the unretirement as a planning tool. Part-time work can supplement income if needed, provides a buffer during severe market downturns, and also supports purpose and well-being. And also mental health is a big thing in the last 10, 15 years. So that also sort of improves that aspect. So what are the key takeaways? Key takeaways here is retirement income planning is different in volatile markets. Second is flexibility matters more than perfection. You don't necessarily need to be sitting there picking the best performing stocks each and every year. You need the flexibility that you can manage that consistently, which over the long term matters more than perfection. Third here is a sustainable strategy can help reduce emotional decision making. We didn't like it when that Middle East conflict started in late February, early March. But going into that, knowing that you potentially have 2 to 3 years sitting in low risk assets or cash, means that you're not going to be as emotionally affected by something as sort of provocative as that on your pockets that had obviously in March and into April. So the goal here isn't to simply to maximize returns. It's rather to create confidence and sustainability. I see a comment here, I'd add a sixth strategy, downsize residence. Correct. Realizing, I mean, many people do treat their main residence as a retirement asset per se. And yes, downsizing that residence, realizing that equity, moving to a smaller house or a cheaper part of the country, for instance, is another strategy. So thank you for that suggestion there. So yes, what we're trying to do here is to try and create confidence and sustainability, because I touched on this earlier. You're not retiring with a final salary pension that you've built up over 30 years with zero flexibility for the rest of your life. You are in charge. You're in charge of your retirement. You're in charge of the decision-making, the personal decision-making. Obviously, for us as financial advisors, this is where we are best placed to step in and assist, but it's up to essentially you to be able to take that first step. So, any questions? This will be the final parts. I think I did go over a little bit. Do you guys have any questions for me? Potentially, how much cash should you hold? Another question here could be, what's considered a sustainable withdrawal rate? Should retirees reduce investment risk completely? Put sort of the money underneath the mattress? That sort of, how do AWM funds help managing sequencing risk? So that's a good question. Our AWM funds, be it in the advisory portfolio or the Cape Berkshire portfolios, those are built for long-term growth. So the sequencing risk comes down to the strategies that I mentioned a little bit earlier, and those are conversations outside of the actual investment composition of those portfolios. Those portfolios are reacting to market movements. They're reacting to diversification rules. I mean, comparing our defensive portfolio with our aggressive portfolio, that's their job. As a financial advisor's job, we're looking at how do you take those funds and map that out over a 5-10 year period of retirement, for instance. So the sequencing risk is where your financial advisor will step in to assist. So that wouldn't necessarily be down to the portfolio composition of the AWM funds. Those are built for long-term growth within those different risk profiles. Another question here could be, how does inflation affect retirement income? So I'm sort of prompting a few questions there. Any further questions from your guys' side? Yeah, I do see I've taken the full 30 minutes. I thought it would be a little bit quicker than that, but evidently I like the sound of my own voice. So I'm also happy to answer questions offline. So yeah, happy to do that. Any final thoughts? Any final questions? Otherwise, we'll leave it there. Great, Isa. We are all set. But yeah, thanks very much, guys, for joining. And look forward to catching up. Look forward to chatting with you guys in the future.
Thank you, Greg. I'm just going to switch over to the poll, and then whoever wants, they can fill in the survey, and then we're all good. Thank you, guys.